Are you ready to take your first steps towards financial freedom by investing in property? Whether you're a first-time investor or you've started your portfolio but need some help continuing to grow, 2022 REB Buyer's Agent of the Year and Rising Star finalist Lachlan Vidler and his team at Atlas Property Group are here to help. As experts in property investment, Lachlan and his team are ready to help you take your next step in growing your portfolio. By completing the research, sourcing and negotiations, Lachlan goes the extra mile to find you a high-performing investment property. Visit atlaspropertygroup.com.au to book in your discovery call absolutely free of charge.
This is a Momentum Media production.
Welcome to the Smart Property Investment Show, the podcast by investors for investors.
Good day, how you going? Phil Tarrant here. I am your host of the Smart Property Investment Show. Hope you're well. Hope you're staying dry if you're on the west or the east coast of Australia at the moment. We're sort of going through this, what do they call it? 1 in 1,000-year weather event. It's raining today. It was raining yesterday. It was raining the day before. It was raining a lot today. Seems like roads are starting to flood again after a bit of a turning down in over the weekend. And we're all familiar with what is happening up in Lismore, northern sort of areas in New South Wales with those floods. Some pretty disturbing scenes coming out of there. It looks like the whole town of Lismore has been taken out. And sort of saw a video from a mate of mine who went through there, and it looks like a war zone. So what they're going to do, they're talking about whether or not they rebuild the city somewhere else. Who knows what's going on? But a lot of people doing it tough out there at the moment. And I thought with you on the Smart Property Investment Show, and it goes to show for property investors the need for good diligence when you are buying and some of the considerations you need to take on board should you be investing in flood-prone areas outside of the scope of this chat. But I just wanted to acknowledge that the great work by our SES, also the military who's getting involved, and other civilian volunteers helping with the cleanup effort and helping to save lives where possible. So our thanks and appreciation to you. There's lots happening in property at the moment. So everyone's got their ear to the ground when it comes to what the RBA is going to do, what's going to happen in interest rates, whether or not prices are going to go up or down. Some of the banks are telling us that expect rate rises and expect drops in property. These are the same banks that told us back in March and April of 2020 to expect 25% drops in property. So whether or not they're going to get it right this time, who knows? We're going to have a bit of a chat about that today. Joining me in the studio, Arjun Paliwal, InvestorKit. How you going, Arjun? You well?
Well, as always, my friend, great to be back on again. And yeah, pretty tragic stuff with the floods and what's happening. And so much for a 1 in 100, 1 in 1,000. I mean, I think just Queensland alone was 1 in 10 now.
Yeah.
So,
well, I was actually looking in the paper this morning about, for those of you in Sydney, western suburbs of Sydney, like Windsor Way, right? They built this brand new bridge out there, I don't know, 3 years ago or something or other, 2018, 2019. The idea was that it should be able to handle sort of they started the 1 in 5 year floods, and everyone went, no, we don't need it that big. It's probably a bit too ugly, a bit of an oversight. We don't want that. So let's make it so it sort of does 1 in 3 year floods. Well, that's flooded twice in 12 months now. So everyone's sort of scratching their head going, well, we didn't get this right. So just a reminder, Arjun, I don't know, you don't mess around in flood affected areas, do you?
No, we find pretty good ways to avoid them through due diligence and yeah.
Yeah, it's topical right now. So if you are investing, make sure you keep an eye on those flood overlays. But Arjun, I read a really good piece by you a couple of days ago, and I thought it'd be a good opportunity to have a yarn with you about it and sort of break it down and dissect it and get some commentary around it. It's a blog post, I guess you would call it, on your website, investorkit.com.au. It's called 4 Risks to Have on Your Investing Radar. Now, you can only do so much through the written word, and you've got to be quite polished for this stuff. So it's always good to talk this stuff through. Arjun, this piece here, 4 risks to have on your investing radar, it's probably as relevant today as what it always is, irrespective of floods and not floods. But you're right here, cash flow and capital growth are the 2 key goals of property investors. You completely agree. Some are more cash flow, some are more capital growth, some are both of them. You continue, many investors today put too much of their attention on good affordability, high yields, or proximity to capital cities. However, even when these features look good, there may be risk behind the scenes that could cause underperformance in the long run. Today, we're going to talk about 4 of these key risks that you should always keep on your investing radar to play the game safer. They are, number 1, high vacancy rate. Number 2, high building approval rate. Number 3, high inventory. And number 4, weak local economy. So a bit of a guiding scaffold of key points there for property investors to help mitigate risk when it comes to investing. Yeah, I reckon you're on the money with those 4, Arjun. Well, what's the catalyst for producing the particular piece of commentary on your website? It must be something that people are asking you about all the time.
Yeah, the biggest thing that sparked my interest, Phil, was everything to do with how many things there are out there to do. And because there's so much out there to do, like, hey, you should do this, you should buy brick or this or weatherboard, don't do that. Like this whole list of to-dos is very paralyzing for those who, I guess, overanalyze or feel like they'd like to get a really good analysis together. Then I kind of stood back and said, look, the property world, firstly, it should be a complex tool. I mean, it's not a simple, yes, we can whack out certain words that demonstrate that it's just demand or it's just supply or confidence is high or low. But at the end of the day, like property isn't simple. It is complex. But at the same time, how can we simplify it? And I've always found that if you focus on what you shouldn't do, it makes the to-do a lot easier. So I thought, why not sit back? Why don't we kind of look into the research around if we had the 4 most important things that made us feel, if you don't do this, and there was 1,000 to-dos out there, and instead of confusing yourself with 1,000 to-dos and you just focused on make sure you don't do these 4 mistakes, your chances of making a better or more successful decision, that's tenfold. So that's kind of where I felt that for those who need a bit more freedom in how they operate, or those who just need less confusion to stop themselves being paralyzed by overanalysis, just focus on these 4 don't do's and the world will probably become a lot easier for you.
Yeah, so you call this 4 risks to have on your investing radar. I'd probably call it 4 red flags, as in if you see this, ask the question.
Mr. Journo coming out on top with the headlines and everything.
You like that, do you?
Yeah, that's good. That's a very good one.
That's what they pay me to do. I don't know what I'm talking about, but typically I'm all right at thinking of that sort of stuff. Now, before we get into this, Arjun, I think they're really good. High vacancy rate, high building approval rate, high inventory, weak local economy. They're good flags, red flags. What do you reckon of property markets moving forward? Well, I've got you here. We're all familiar with the commentary, the sort of tabloid media, the ones that were telling you back in sort of early to mid 2020 that if you're investing in property, you're an idiot because you're going to lose all your wealth. These are the same media outlets who 6 months later told you it was boom time for property, hurry because you're missing out. Now we're getting told another cycle, property's going to go down in value again. Everyone's going to blow their dough. We're going to see a number of years of weak growth. What do you subscribe to? Where's your position, Arjun?
Yeah, so I think the perfect thing about this blog article is that we can take these 4 points and just make it as wide of a net or as small as a net as you'd like to. So instead of talking about a city, let's talk all of Australia. And if we apply these 4 points just to all of Australia from a perfect example is, okay, avoid high vacancy rates. Vacancy rates have not been as low as this for as long as I can remember. We've got multiple capital cities, the majority of them sitting at below 1%. So Adelaide, the lowest mainland capital, and then Hobart, the lowest in Tassie. So when you think of that at 0.4, 0.3% vacancy rates, now Perth is below 1%. This is just huge. So we're in a rental crisis. So the first thing is high vacancy rates. Is that happening? Are we seeing risks of that happen? No. It's probably going to get worse in terms of the vacancy rates for tenants. And that means that there's a big tick on that angle where there's no red flag. The second one is high building approval rates. There was a bit of a sugar rush in building approvals, Phil, when Home Builder came along. If we looked at most statistical areas across Australia, we do see a spike in their curve, but those are now falling off that curve because that was a sugar rush hit. It wasn't a sustainable move. It was a lifesaver to kind of keep things well placed. But now all of a sudden we're seeing many people turned off the idea of building new because of the construction costs that are picking up, because of the uncertainty of when they might even start or when they might even finish, and the stories left, right, and center of some pretty big names going bust or not able to deliver the same contract prices. So the second red flag of high supply, if you're buying a house, the basic bricks and mortar, not your units and townhouses, then we see that building approval rate being pretty weak. The third one, high inventory. So this is about existing supply, Phil. So if there's a lot of listings online, a huge trend and increase in listings, then obviously high inventory can become dangerous. Another way you can get high inventory is a lot of reduced sales volume. People take the foot off the pedal in buying, and hardly people want to buy. So none of these two things are occurring in Australia as we speak. Listings are far lower than previous highs across many of our cities, with the exception of Sydney now. The listings have been picking up. Likewise in Melbourne, they're not substantially below their previous highs. They are kind of in that more stable environment from a couple of recent months of uptick. But then you've got the Brizzies and Adelaides and Hobarts, which are massively below their last 5-year averages. So we are going to see a split in terms of performance. They call it 2-speed. I'm going to call it 3-speed now. Houses and units separation, the biggest capitals to smaller capitals and regionals separation, and then now the smaller lifestyle regionals that are going to be extremely tight remaining based on this high inventory. So no, we don't have high inventory. Then the fourth part, unemployment rates as low as they could be, job ads spiking all over the place as high as it could be, infrastructure as high as it could be. So just basing on my 4 red flags, Phil, I can't see any of these 4 red flags across Australia right now in the majority of markets. A couple of markets obviously a bit more sensitive with their inventory levels, but the rest of them, no.
Yeah, and you look at that weak local economy. Well, in many ways, the Australian economy is booming at the moment. The biggest problem, we're constrained for additional growth because we can't find people or we can't get some resources in here, right? Like that's the biggest issue we have right now. They're talking about ongoing growth. Hence the reason why this big question around the cost of living and CPI sort of going up, wages. I know the RBA is waiting around for real wage growth to see what happens there. But to your point, then, if you look at Australia in the context of some of the commentary around, we're going to see these significant price drops. Your thesis here, if you use these 4 things as a pillar that would indicate a market in distress or a market of concern, you're saying that they're not present at all in Australia largely?
No, the majority of markets, all those 4 of them are a fairly big tick. Obviously, in your units and townhouses, there are still high levels of inventories in a few places. So that's 3 out of 4 ticks. And then in, our biggest of cities, we are seeing a recovery in supply. So I'll call that a 3.5 out of 4 ticks. But the majority of Australia, I'd say more than 3/4, Phil, sits in a, 4 out of 4 ticks across those things.
So the question I have for you then, Arjun, is why are these highly educated and experienced bank economists telling us otherwise, that expect all these reductions in prices? Is that all of them banking on the fact that interest rates are going up, or is that all of them banking on the fact that if they keep talking about interest rates will go up, maybe they'll just go up? Like, what's going on, mate?
Yes, I think the key thing is oversimplification of property. The problem that we have here is that my research analyst and myself, we sat together and spent a week just pondering about the 4 key things, red flags. So we've sat a good hard week drawing back and forth conclusions to understand what are the 4 things we could come down to. How difficult is that? Like, to come down to 4 things taking that much time, whereas these economists and high profile positions are relying on one thing and it does everything. If I could rely on just one thing to do everything in property, I'd be writing an article that says 1 red flag, don't do this, or 1 thing, just do that and you'll be fine. So because property is far more complex, it's got so many moving things, it's as a result where the oversimplification of it by larger names, also because they don't have as much airtime to constantly go through and write a 2,000-word blog post on, different things and influencers and impactors, they've got this little bit of airtime to go, where is it heading and why? And that where is it heading and why is kind of this one thing. They'll harp onto interest rates, or they'll harp onto building apply approvals, or they'll harp onto inflation. I can see the indirect impact of where their thoughts are coming from, though. Like, everything that they're mentioning is not, not that it can't happen, but it's more so just hoping that one thing equals X, which isn't property investing. For example, a lot of these thoughts are stemming from hyperinflation, lots of expensive goods and services, making our data even more towards the edge of rate rises. And then the rate rise worst case scenario isn't this kind of well-controlled, well-oiled rate rise machine, but it's multiple successions of rate rises that don't just create a soft landing, but a hard shock. Then you combine the compounding effect of rate rises with borrowing capacity reduced because they're tied to each other, households becoming a little bit more stretched. But then does that consider all the money in offsets? Does that consider how low we're at in interest rates? Does that consider the LVR of Australia being just over 20%, which means that we're not really as debted up as people think we are? So because of all these things, Phil, I just think that it comes down to the oversimplification, people just making it sound like A equals B kind of thing.
Yeah, I'd sit there and and I sometimes, when you look at the performance of some of these economists, I'm not an economist, it's like, that's not my bent. I'm just a podcaster, right? But these economists are leading the charge inside of major institutions where either Australians leverage them to create wealth, or they hold a lot of wealth themselves as shareholders and whatnot in their super funds and retail funds and SMSFs or whatever. But it's like being sometimes a weather forecaster, it feels, where someone stands up and goes, tomorrow's going to be bright and sunny and it's raining, or they're going to go, rain's on its way and then it's bright and sunny for the next couple of weeks. Who knows? And, the big question mark for me is they got it so wrong in 2020 around price drops. Are they going to get it wrong again? And a lot of investors will be thinking this way. Now, the point being, Arjun, irrespective of the market cycle, there is always good opportunities for investors. And that's what the smart investors do. They don't get too absorbed or swept up in a lot of this rhetoric around it. They look for where those opportunities are, how to identify them. And you've given them a structure for these 4 points of how to de-risk your investment. The point you made, though, was that you said Australia's LVR is 20%. So there's only 20% of the total value of residential property in Australia has debt on it. Is that correct?
Yeah, so just over 20% at the moment. So I think we're tracking
like 30. I
think we're tracking at close to 2 trillion in debt with over close to 9 trillion in value. So it's just tracking over the 20s. So there's a lot of people with either very little to no debt, or there's a lot of very high paper values, which some people may or may not agree with, right? One or the other is happening.
Anyway, there's some stats there, but let's get stuck into these 4 factors at a more micro level and the nuances of them and how it will shape and influence the way you invest. We'll just go to a break beforehand. Stay with us. We'll be back in a moment. Welcome back, everyone. It's Phil Tarrant, host of the Smart Property Investment Show with InvestorKit. It's a regular guest on the Smart Property Investment Show, Arjun Paliwal. I think I overpronounce your last name sometimes.
It's got the ring with the little L's in the middle. You can go Paliwal. We're just like
how do you say it properly?
Oh, mate, Paliwal. You nailed it.
Yeah.
Look, at least it's not the stuff I used to get in primary school and high school. There used to be all these Pokemons, Poliwhirl, Poliwag, Poly this, and you're like, hey, that's the Arjun Pokemon dude, Poliwag, isn't it?
Anyway, we'll move on from there. Hey, guys, you're down at the Real Estate Business Awards the other week, mate. Finalists in some awards. Well done, mate. That was good to see.
No, it was good. It was a really well put together event. And I think the most fun part was seeing my team meet many of the agents across the country where, you've been hammering them on the phones like, hey, mate, where's the next off market coming? When's the next one coming? And now you finally get to see them in the flesh and go, dude, I'm so sorry I bombed your phone 30 times last week and asked you about these properties coming up. But lovely to meet you. So that was pretty cool. And the other one was we're very grateful to be Buyer's Agent of the Year finalist 2 years in a row now. So hopefully it's a case of third time lucky for next year, Phil.
Yeah, mate, fingers crossed, get stuck into it. And so agents are pretty happy with buyer's agents at the moment, or you're still sort of persona non grata? They want to go directly to the customer, or you're starting to provide an easier way for them to sell properties?
Look, it's a bit of both. I think the main thing that I noticed about 2021 was we unlocked a channel that they really weren't actually getting listings in. So to give you some context, there was a lot of vendors who were struggling with where they would buy after they sold or where they would move into after they sold. And that was probably the largest percentage of objections vendors agents were getting. So you imagine this huge bottleneck and not being able to get listings. That was it. Now, we provided solutions on over 200 occasions from purchases we made where not all of them represented it, but maybe I'd say 25%. So 50 out of the 200 plus or 50 plus represented us going, well, we'll just rent it back to your vendor. We'll happily keep them there. We're investors. We'll find our client a property. And this resulted in A vendor's agent getting a listing, B, a seller making money on a rising market and having their cash to sit back and find some time and not losing the home, staying at home. And then C, it gave us an off market that one of our buyers could, find a property in a rising market. And so that was, I think, where the love came from sales agents and us over the last 12 months for sure. But then, of course, there's the odd ones who just don't want anything to do with us.
Maybe your soundtrack for InvestorKit is why can't we be friends, right? Is that the these things ebb and flow as markets change, the dynamics change as well, and you're the most coveted people, buyers, agents, when markets change and agents want to sort of shift stuff pretty quickly. But let's get stuck into some of these factors, Arjun. 4 risks that have on your investing radar. Number 1, and I want to sort of just dissect it. You sort of spoke about these 4 things at a national level, but let's look at how they work in isolation, and then we can look at how they work together. A high vacancy rate. So you've got to be careful of this stuff. If you are looking to invest in a market as a property investor and it has a high vacancy rate, red flag.
Totally. Phil, I think, look, I've been into my literature, do a lot of reading, research during my studies as well. And many Oxford studies point to real demand in housing to do with the rental market. Many people get trapped into, look at the prices and where it's going, and look at how things are growing and double-digit price growth in this city or that city. The auction was chockers. But at the end of the day, if you really take a step back and you go, what is real demand when it comes to housing? If you think of a house market for sale, you have a part of you that wants to buy it for today's value, but then you'll always have a part of you that goes, you know what, if 10 years later, this could be worth double. So there's a nature of your buying that includes speculation, whether you think of it as speculation or not, it includes it because you're hoping for it to do well. Whereas I don't go to a rental property and go, this is just phenomenal. Can't wait to rent here. Can't wait for Phil to jack up my rents $50 because it's such a good place. I'm not thinking that at all, Phil. So the truth is, if I'm fighting over rental property, it's real demand. Houses there, renters there, and people are either going for it or you're not. So that truly is a sign of market health to begin with. But the second thing is, when you start having higher vacancy rates, it's got a flow-on impact. A, it reduces your sentiment to want to invest again if you're there vacant forever. B, it will actually also impact your pocket because you're sitting there vacant for more. And then C, it's got the impact of lower rents, because if you're going to have decreasing rents, it's also going to impact your pocket. So 3 things there you don't want. If you're looking for a sweet number, ignore what the numbers used to be thought of in the past. Everyone used to think 3% was the balance point. It is not the case at all. Done a load of back testing, load of data analysis. 2% is the balance point, not 3. So if you'd like healthy rentals, it's below 2.
You put that in context though, Arjun, you're saying it's instead of 3, it's 2. I can't really make a formed comment on that. However, I'll look at the environment that we're in right now, and we have a lot less people in Australia as a result of COVID-19. What I'm talking about there is the pause of migration. So is that 2% even realistic once you get normal migration coming back in? There's going to be a lot of people lining up to get out to Australia with borders now open. Is that realistic? It's going to be even tighter, do you think, moving forward?
Yeah, so we're already tracking at the majority of our regional cities sitting below 1.25 and even 1. So that's extremely tight. And then the majority of our capitals are sitting below 1% as well. So when we're thinking of that, we're already extremely low vacancy rates. And with this pressure of borders opening and not much stock coming on from investors or being built, I think they remain quite tight. What I am saying is that if you're seeing a market and you look at it and go, hey, this is a good market, I like the yield here, and the vacancy rate's 3%. Or 2.5, one used to think that was balanced. Well, the truth is you need to be below 2% in our opinion to see rents correspond with some rises at a healthy level, and for you to find someone within the first 1 to 3 weeks. So I definitely feel we're in an environment where many investors are somewhat lucky with lots of below 2% vacancy rate markets. But if you are kind of in this environment still seeing over 2% vacancy rates, then it's probably a bit of a red flag.
Yeah. Okay, good. And my recommendation, go and chat with your property manager and have a yarn with them about if you've got rents coming off lease terms. It's a lot of upwards pressure on rents. You may be able to review those rents at that point in time. A lot of my property managers are being proactive, saying, hey, Phil, your rent's up in May. We should be giving them a notification now that we're going to be increasing it. And because rental vacancies are so low, it's a lot harder for them to go, stuff it, I'm not paying that, I'm going to go move somewhere else, because guess what? There's nothing else available. And this is how you get collective upwards positive price pressure on stuff like this. So speak to your property manager, have a review of your portfolio, see how you're going. Now, the second point here, Arjun, which is a bit of a red flag when you come into investing. So high building approval rates. So if you see or seeing a lot of building approvals in a particular area, what does that mean?
Yeah, so a lot of building approvals, there's some unknowns and knowns, right? The known part is that it means that over the next 1 to 3 years, there's going to be a lot of building activity transition from approval to construction and houses either, being moved into for sale or for rent. Now, the known part is that, so we can immediately say over the next 2 or 3 years, there's going to be an injection of supply. What's the unknown is, are all these builders building for investors, or are they moving for owner-occupiers? Now, I'll give you an example. There are many parts of, say, Blacktown, which had an extremely high building approval rate between 2016 and 2019. These building approval rates represented 8 to 12% of new stock coming on board. So what that meant was, for every 100 houses in Blacktown, there was 8 to 10 being built in approval phase, about to be onto the market or on for rent, or someone moving into it. Unfortunately, Blacktown's building approval rate represented a lot of people wanting to live in the area, but you never know that, right? But a lot of people wanting to live in the area meant that prices still had upwards pressure, and prices grew by 32% over that 5-year period from 2016 to 2021.
Yeah.
Now in Hornsby, if you flip it over the other side, you've got building approval rates of 0.8 to 1%, super low. So for every 100 houses, there was only one being built. Well, the prices outperformed Blacktown by 25% more. So not 25% growth, but 25% outperformance. So there's an extra 12% of growth there over the same time period when you have lower building approvals.
So this gets to real sort of, grassroots, ground truth type stuff. So you're talking about Blacktown there. So there was a lot of building approvals. However, most of them were for owner-occupied dwellings. Were they mainly units or houses? And I know Blacktown pretty well because I grew up there and I delivered pizzas around there for 4 years. So I pretty much know every street in Blacktown. Was all those building approvals through first, second, third, fourth avenue type areas, or were they out in the new sort of greenfield developments? Because Blacktown as a collective, as a council, is pretty big. So what did it really look like?
Yeah, so this one was the houses, but more Blacktown region. So not just the Blacktown sort of suburb itself. I'm a fellow boy of that area as well. I live out in Glenwood, so it takes me 8 minutes drive to get out to Blacktown, West Point. So I'm pretty close by. But yeah, that in comparison to the Hornsby region, quite far out as well. Not just the suburb of Hornsby. There were two worlds apart for approvals. But you made a great point, Phil, around the owner-occupiers coming in and dominating. So that's a perfect example where the data shows super crazy risk because of 10 to 12% building approvals. But still, it didn't eventuate to become this catastrophic market decline because a lot of the buyers were owner-occupiers. So that's kind of where, if you're operating off data alone, you're going to be able to apply it to de-risk it, but you won't get it completely right. If you knew that Blacktown demographic and knew the pressure of owner-occupiers looking for something affordable, then of course that risk is now taken away. But if you're sitting in Sydney and you're trying to make a decision for somewhere, say in regional Queensland, you'd look at that 10% number and go, hey, that's too much building happening. I better cool off here because I don't know that market intimately. And
this is why you need to interrogate the numbers. I know a lot of armchair property investors who do everything by looking at numbers, and they don't understand or appreciate the nuances that are taking place on the ground. So you need to get out, get boots on the grounds. And that means looking around and getting a sense for it, talking to builders, talking to the guys building the houses, talking to the real estate agents who are selling them. Who are they selling them to? Who's building them? You should be able to find out all this information. So you got to get the balance right across both those two factors. And I know, Arjun, you're a podcaster yourself, Property Nerds. It's a podcast you do, syndicated on the Property Investment Podcast Network, which you're listening to this show on. You're a data guy, right? But you still get out of your probably Bentley and drive around and have a look on the ground about what's going on. You don't only rely on the numbers, right? But the numbers give you clues.
Of course. Firstly, it's a 2001 Pajero with a crack to the side of the windscreen that I got to fix up, actually.
I just read that they're going that would be a really good car, the 2001 Pajero. That's the boxy one, right?
That's a very boxy one.
They got to get it back because I reckon it's one of the best cars. It's easy. They could do a retro version of it. Anyway,
there you go, right? So, and that too cost me $1,000 to get. So that one is a pretty special one. But in terms of where I'm heading, yeah, field trips galore. We were able to head out to a lot of the cities now that since the borders are opening up as well, that's helping a lot. I've been visiting Tamworth, Townsville, Bundaberg, Adelaide, Brizzy, Wagga, all over the country, just to make sure even those markets we're buying and not buying in, to get a really good idea of what's happening. And that's part of what we do to mix the data together.
Yeah, I think it's important. I was up in Darwin, I think I spoke about a couple of podcasts ago, a couple of weeks back, and I've been there for years. And it was good to actually I'm reasonably well informed about Darwin property markets, but to actually sit there and walk around it and have a look and get a sense for it, completely different paradigm to our thought about it right now. So if you're going to invest in property and do it well, you got to travel, you got to get out there, you got to do this hard work, or alternatively, you pay someone to do it. And that's a buyer's agent. That's what I do. Much more effective in terms of time and effects and outcomes. Arjun, we'll go to another break. When we come back, I want to break down these other 2 points, high inventory and weak local economy. Stay with us. Back in a moment. Welcome back. Phil Tarrant, host of the Smart Property Investment Show with Arjun Paliwal from InvestorKit. Arjun, high inventory, red flag. So if you see a lot of properties for sale, be nervous.
Mate, inventory is a super important number. It's not given enough importance in the Australian property landscape. And it's actually the genuine display of demand and supply, the two favorite barbecue words that people love to throw out. But with demand and supply, it's listings versus sales volume. So how inventory gets calculated, Phil, gets represented as a months of stock. So for example, if you had 100 listings online in a suburb, and then you had an average sales volumes of 33, you would say 33 sales per month, there's 100 online, there's 3 months worth of stock here in case nothing else came online. There's 3 months worth of sales activity. So what that means is then you can now gauge how many months of stock. High months of stock will equal oversupply, and a low months of stock will equal undersupply. What I've often found is that 3 to 4 mark is a balanced market. Sometimes 4 to 5, depending on the conditions we're in. And so if you're targeting high inventory markets, guess what? You're going to have stuff that's a lot of available properties, and it probably means little to no price growth. And we also have found quite clear correlations, Phil, to low inventory with price rises in the next 12 to 18 months. So to give you a perfect example, we analyzed in this blog post the 2 Victorian regions. One was the suburb of Wyndham, or region of Wyndham. This is the far western regions of Melbourne. And the other one was Bendigo, somewhere where I've personally invested myself, invested for many people as well. And during that time, where I look at December 2020 till December 2021 data, so a good 1 year and very recent as well, Wyndham region had inventory levels of 3.7 months of stock. So not a super tight market, but not high risk. Still though, not extremely tight. Bendigo had inventory levels of 1.9 months of stock. So now we're talking some, extremely tight levels of stock here. And this also means that there's a crunch on supply and lots of demand ready to soak it up. So looking at these 2 data points back in December, had you gone, okay, I'll buy in Bendigo because of the 1.9 months worth of inventory versus Wyndham, you would have come out close to triple in performance over the same time period of 1 year. The Bendigo median prices rose 21%, whereas the Wyndham region rose 7% as a whole region. So it just clearly shows that the importance of low stock. Now, where buyers hate this, Phil, is actually that it's competitive. And this is really where it gets interesting. One part of you goes, I want, lovely off market, under market, all the fancy buzzwords of the industry. I want all this cool stuff to make me feel like I've got the sweetest of deals. But then can that exist at high volumes in competitive markets? The truth is no. So competition, I'd rather go competitive environments than I would, constant deals and sweet terms.
Yeah. And there's 2 types of inventory. There's the inventory which goes up and there's lots of it and it doesn't move. And that's a big red flag. But then there's another inventory. And again, it's sort of ground truth type stuff where if there's a lot of properties coming on the market for sale in a particular area, and it sells really quickly, it's a really good indicator. So when you drive around and you see for sale and sold stickers on everything, that's another indicator of high inventory, which isn't necessarily a red flag. It could be a positive high inventory factor because it's those properties that sit languishing on the market for a long time, which puts negative price pressure on suburbs. But when you see high transaction rates moving, keep going north, if you can make your time that market quite well, you can do quite well out of it, Arjun.
Yeah, and that's what you've just hit there, Phil, is the double view. Look at your volumes and look at your listings. Too many people go, oh, there's hardly any stock. But what if at the same time there's not much buying? You know what I mean? So, there's lots of people buying here. It's going crazy. Yeah, that's great. But I do also see a lot of properties available. So great point on making sure that you look at it from both angles so you can get a clear mark of inventory. Yeah,
and let's talk about this last point, Arjun, which is weak local economy. And local economy, by that, I would talk about your Blacktown or Hornsby example. I talk about what's going on within that the sort of the city limits. Blacktown's a big place and Hornsby's a big place. Diversified economies, all of them, industrial, office, retail, work from home. There's a lot of jobs. There's a lot of local infrastructure. People can actually live and breathe and not move out of those areas. They are big economies in itself. So what would indicate a weak local economy? And no doubt your first point would be if it's only got one key economic driver, i.e. a coal town or some sort of mining town, the single source of employment dries up and no one's got a job. That's probably not a good thing, is it?
Yeah, so the weak economy versus strong economy, there's a couple of myths to throw into there that many people lead to believe, but also there's a few things that you've pointed out that are very important factors. So one thing you talked about with the Blacktown and Hornsby example is that Sydney is a city of many economies. So we've got to get macro and micro at the same time. Now, for example, people who could live near this new airport in the far western suburbs will likely live, work, eat, play there. So what does the northern beaches or eastern suburbs have anything to do with that? So it just shows you the size of Sydney and the beast of it and how the economies are so different as well. But then on the flip side, there are people who, go to a small town and see that, there's no building in Toowoomba that's bigger than 5 or 6 stories. And then you go, there must not be any jobs here. It's not a major city. There's no economy here. And this is where many people make the opposite mistake, where economy isn't judged by how tall the buildings are and how many people walking around in suits and ties. There's such a diverse range of industry in Australia, from agriculture to tourism to industrial and the commodities of, mining and so forth, and the finance industry. It's broad. So the first thing is we're looking at this overarching number of unemployment. So this is just capturing everything. The second thing we're looking for is job ads, which tend to have a negative correlation with unemployment. So you see job ads flying up, you'll see unemployment soon thereafter start to fall down. The next thing we're looking at is what you pointed out, diversity. Are we looking at multiple different industries? From there, we're also considering things like finance trends in the state, equipment finance trends, business sentiment surveys, consumer sentiment surveys, households migrating, internal migration. They're people who instantly have money and desires to do things as they move. And also we're looking at passenger movement. So tourism perspective, airport passengers is one example. So with an economy, Phil, I think the first thing is to separate them, to say, don't take a whole city as a city, the Sydney example. And the second thing is don't assume just because a city's small, it doesn't have a strong local economy. And as we start to tick all these boxes, tick, it's got many job industries, or tick, it's got great diversity and very increasing amounts of job ads, lowering unemployment. All these things come together to increase confidence in a given market. So that's a key part.
Yeah, and essentially summarize that, it's horses for courses. You can't apply your paradigm for a strong local economy as you might see in Blacktown as you would do in Toowoomba or Ipswich. You need to look at what the underlying economic drivers are for each of those different economies and then overlay that and apply that with a common sense approach. And you make a good point, Arjun, about Sydney as an example, and Melbourne sits there as well. Do yourself a favour tuning into this. Google biggest cities in America by population size, and it'll list the top 10 cities. If you put Sydney and Melbourne into that list, I think we're number 5 and 6. So maybe even higher now. So if Sydney was in America, it would probably be one of the biggest 5 cities in America. And people think, oh, wow, America, it's huge. It's got all these like New York and Chicago and San Francisco and LA and Phoenix and whatever else you want. Sydney is a big place comparatively. And a lot of people sort of forget that when they consider Sydney as a market or Melbourne as a market or Brisbane as a market. You have many, many different micro CBD or CBDs inside it. Sydney, you've got Campbelltown, Liverpool, Hornsby, Blacktown, Penrith, Chatswood. What sort of down south can we go? Somewhere like, Sutherland Way. These are big in their own rights cities. Wyong on the Central Coast is bigger than Darwin by size, right? Like, so don't make sure you try not to frame everything as in what you expect it to be, because there's always something there very, very different. Arjun, these are really good guiding pillars for red flags for listeners. Pretty easy to remember, those 4 of them. High vacancy rate, high building approval rate, high inventory, weak local economy. If you see all of them, I'd probably run away. If you see 2 of them, you probably put a big question mark. If you see 1 of them, go, okay, why is that the case? Let me look into this a little bit further. So that's probably how I'd be using those things.
I'm a big believer of research tells a story. And these 4 things, if you actually summarize them, Phil, a lot of properties available for rent, lots of people building with soon to be built properties, a lot of properties for sale in comparison to what sells, and not a lot of job ads, not a lot of employment diversity, not a lot of, low unemployment environments. So if someone's saying all of that to you in one sentence, how can you look at that person in the eye and say, fantastic, I'm going to buy a place here, right? Like, it just doesn't make sense.
Mate, you know what? People still do it though. And no doubt I'll get a call from the mayor, but I look at like areas like, let me just pluck one out. Alexandria on the way out to Mascot Airport if you're coming from the city. High vacancy rate, i.e. no students around at the moment, even though when we've got heaps of students, still a pretty high vacancy rate. This is, if you don't know Alexandria, it's just high-rise, cookie-cutter apartment blocks. It's probably a bit unfair. There's it's cool stuff around there. There's shops and stuff. High building approval rate. People are flogging off generational land and they're building more and more of this stuff. High inventory. Yep, definitely. And weak local economy. Well, to be honest with you, you got less people living around there. So no doubt there's a lot of the small shops, et cetera, are probably struggling a little bit. So that's a bit too micro. But that would be an area right now, it's not forever, where I would say, yeah, I'd probably shy away from those spots. Guess what? People keep buying off-plan apartments out there, though.
Nailed it. No, honestly, if that's the paragraph just there, Phil, you nailed it to go, if someone got an apartment or townhouse thrown in front of them in that pocket, that should clearly show you that fails the 4-part test.
It's good.
Unless you like your good coffee, though. Alexandria is really good coffee.
I like Alexandria. You got the ground. You got the grounds out there. It's pretty fancy.
That's right.
Possible to get a parking spot, but that's pretty good. And like that whole, was it Green Park, Green Square? I can't remember. Well, I don't know if go and have a drive around there if you're tuning into this. You're sort of Sydney based. Give it 20, 30 years. I'm sure it'll all pick up and fire. But right now, they're not slowing down on building those high-rise apartment blocks, are they?
No, and I think the whole another part you could almost add in a little 4+1 bonus, Phil, is that the 5th point is that people are largely making these investment decisions because they're uncomfortable or aren't aware of what else is elsewhere. These apartments in these areas aren't cheap. They're probably 700 to $1 million. Just imagine the different markets across Australia that carry houses that have done 20 to 50% capital growth in the last 2 years alone, just simply because it wasn't up in the sky. That alone.
And that there is a sage, a very important point. We're going to leave it there, Arjun. That's a really good concluding factor. Make your money work best for you in property investment. Why plug it into something where you might get mediocre growth when you can plug it into something else and get accelerated growth? And the top line of this particular blog post for risk to have your investing radar, you talk about both cash flow and capital growth, mate. I don't know any investor that doesn't want both of them happening simultaneously. If you had to choose one of the over the other, it's going to depend on where you are in your investing journey. Arjun Paliwal from InvestorKit, thanks for your time today. Really enjoyed it.
Thank you, Phil. Appreciate it.
Nice one. Plenty more Arjun. Go and check it out. Just search wherever you listen to this on the Property Investment Podcast Network. You'll also find Arjun's Property Nerds podcast. He's a proud nerd. Happy to put his hand up as a nerd. He loves his data. I reckon he just has thinks and dreams at night time, data, property data, and he's got a wealth of it. So have a chat with him if you can track him down on the internet or social media. I'm sure he'd be happy to have a yarn to you. Arjun at InvestorKit. Remember to check out smartpropertyinvestment.com.au. One favour for me, please. Keep those reviews coming on whatever podcast platform you're tuning into this on. Team get a real kick out of it. It's just not me talking on the mic. There's a big team who do all the coordination and post-production and make me sound good. They get a real kick out of it. See you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
Looking to secure finance to maximize your returns on your investment property? Finny can help. With access to over 70 lenders, Finny can find the right finance for your unique situation. So whether you're ready to refinance for a better rate, improve your cash flow, release equity to grow your portfolio, or are looking to find the right finance for your next purchase, we're here to help. Visit finny.com.au today to learn more.